Today I thought we could explore some investment themes based on investment reports and research that I've read that could have a huge influence on portfolio values between, well, now to 2030 and beyond. It is probably worthwhile me saying, though, that I don't particularly try and chase investment trends or investment themes as part of my own overall investment strategy as a global stock investor. But it is worthwhile bearing these themes in mind, and they're certainly an area of interest for me because they will certainly impact the global asset allocation of my global stock portfolio. So let's get into it, but before we do so, just a quick disclaimer: this video is for educational purposes only and is not financial advice. Nothing within this video is an investment recommendation. Always do your own research, and when you're investing, your capital is at risk. Artificial intelligence is something that we've all heard of by now, and in fact, according to BlackRock's own attention score, AI has become one of the most talked about investment themes over the last 12 to 18 months. It's also been one of the biggest drivers of stock market valuations too, specifically over in the United States, with many comparing it to the dot-com bubble due to the historically high valuations which we're seeing at present. But whether that proves to be true or not, the question that I've got on my mind is, when does all of this capital that's being poured into artificial intelligence start to turn into cold hard cash? Well, a lot of that comes down to the infrastructure, the chips, the servers, and the giant data centers that make AI possible. But here's the less obvious piece which I think makes the AI investment theme so interesting. And that's the massive amounts of energy that's required in order to be able to facilitate it. For context, the International Energy Agency says that a single ChatGPT query uses 10 times more energy than a Google search. The difference between new age AI versus kind of old age internet is absolutely huge. Sam Altman, who's OpenAI's CEO, estimates that each ChatGPT query consumes about 0.34 watt-hours of electricity. Now, I'm certainly no electrician, but there are estimates that suggest that ChatGPT will manage 1 billion queries a day. That's 340 megawatt hours, which is the equivalent to driving an electric car 1.2 million miles every single day. And that's just ChatGPT. And in actual fact, artificial intelligence is set to grow by 5x over the next 5 years until 2030 across many different use cases, from healthcare to manufacturing, logistics, and finance, just to name a few. And therefore it means that the energy demand and consumption is only going to multiply. To understand this further, I found a little bit of research from WisdomTree, which forecasts a 200% increase in US power demand by 2030, all just from data centers. And big tech are already taking action on this. Companies like Meta, Microsoft, Amazon, and others have been securing deals and investing heavily in new energy sources and facilities. And on top of that, analysts are also expecting that big tech are going to spend an additional $300 billion on AI alone in 2025. And the numbers here continue to get bigger, because a report which I've read from McKinsey estimates that by 2030, that data centers worldwide will require $6.7 trillion just to keep up with demand. To put that into context, that's nearly the size of Japan's whole economy, of which $5.2 trillion are expected to go into data centers, designed specifically for AI workloads. So what does all of this mean? Well, it kind of goes to show that artificial intelligence isn't just a story about making our lives easier with new fancy technology, and instead it's more of a story about infrastructure, energy, and physical assets. From an investment thesis standpoint, the interesting angle is who actually benefits. Is it the companies that design the chips, build the servers, construct the data centers, supply the power, or ultimately run the platforms that monetize it all? But before we dive into the next investment theme, I want to introduce you guys to today's video sponsor, which is WisdomTree. WisdomTree is the largest pure-play exchange-traded fund provider with over $100 billion in assets under management. Alongside their ETFs, they also publish research and white papers on big investment themes, and I've partnered with them today in order to share the next one with you. Early this year, the European Union announced an €800 billion defence spending plan, which has resulted in a number of European defence stocks trading higher so far this year, as a result of this big strategic shift from the EU. Now, the reason why they've done this is that the EU sees Russia as a continued threat, and with Russia continuing to increase military spending over the last few years, far exceeding that of other European countries as a percentage of GDP, many of which have fallen short of the 2% NATO guidelines. At the same time, there's also uncertainty around US support and Europe's traditional security guarantees, which has kind of forced the EU to kind of rethink their long-term defence strategy. This led to a creation of this white paper called European Defence Readiness for 2030. In the paper, it outlines more of the detail around what we've just discussed, and the need for the Rearm Europe plan and the case for a once-in-a-generation surge in European defence investment to essentially re-establish a strong and competitive defence industrial base. As part of this, I've actually got a paper from Wisdom Tree which outlines the European defence industrial strategy objectives that have been outlined to 2030. So let's go through them one by one. First, increased investments and revenue growth. The increased spending, as we've discussed, will unlock significant revenue opportunities for European defence manufacturers, estimated to exceed 500 billion euros annually by late 2020s. Second, focus on strategic autonomy. There are plans to reduce reliance on non-European suppliers by fostering an independent European defence technological and industrial base. Thirdly, innovation and R&D is expected to grow by 5 to 10% annually, offering a competitive edge to European firms globally. And number 4, export market expansion. Europe aims to become a major global arms exporter, increasing exports by 30 to 40% by 2030. These objectives suggest that European defence companies may see long-term support for growth. But with this proposed spending signalling optimism for European defence companies, there are a couple of considerations that I wanted to reference here with this investment theme, and that is valuation and pricing risk. Take Rheinmetall, for example. They're a German automotive and arms manufacturer who have had explosive stock price growth year to date. But with that, the stock is also trading with a price to earnings ratio of 110 times earnings. Now, that pricing and valuation risk is also present with lots of other top European defence companies too, like Leonardo Spa, BAE Systems, Thales, and Saab. Whilst this is a risk to consider, with no doubt some of that upside already priced in, the European Readiness 2030 plan certainly outlines future investment in European defence companies. And as a result, it's boosted market sentiment. But alongside that optimism, there are still risks to consider here, like we've discussed, from market valuations through to political uncertainty. Be sure to do your own research though, which you can do so by checking out Wisdom Tree's European Defence Investment Case, which I'll leave a link to down in the description below for you to check out. And thanks again to Wisdom Tree for sponsoring this segment of the video. Now, the next investment theme isn't particularly new or exciting, but it is an investment theme that's kind of hard to ignore. Gold has surged 40% in 2025 as of recording, with its biggest rally since 1979 reaching $3,690 an ounce. Which I initially thought when I read that headline, well, surely that must make gold one of the best, if not the best performing asset of 2025 so far. So I went on to do some comparisons, and these are the results. You can see that it's outperformed clearly many of the major world indices, and it's even outperformed all of the top 5 companies in the S&P 500 on a year-to-date basis. I mean, do I dare even say it's outperformed Bitcoin so far this year, which has often been made as a comparator, as a store of value. So let's talk through a handful of the macro risks that are present right now, which could potentially support higher gold prices over the course of the coming years ahead. Firstly, we have the debt trajectory, particularly over in the United States. US government debt currently stands at a whopping $37 trillion. Now, to put that into perspective for you, if you were able to save $1 million a day, it would take you 100,000 years to acquire $37 trillion. So it's certainly a problem that's not going away anytime soon. However, to help combat this, President Trump has proposed the One Big Beautiful Bill, whereby he believes his policies will decrease the government's debt to GDP ratio, which is a common metric for measuring debt versus that of other countries, with the expectation that the policies will reduce it from 120% to 94%. That would actually bring their debt to GDP ratio lower than that of countries like the UK, France, Spain, and Italy, whose governments are all highly indebted, especially when we compare them to that of the rest of the world, whose debt sits at more healthier levels, as you can see by this key on the chart which has been provided by the IMF. However, despite such policies, analysts from Wisdom Tree, and admittedly many others which I found on the internet too, don't think that these policies will be quite so beautiful for that government debt figure. With this report stating that the government deficit could increase by a further $2.4 trillion between 2025 and 2034, with this plan essentially having the opposite to its intended effect, with debt to GDP actually rising to 124% by 2034. Nowhere near the desired target. So if this were to come through to fruition and Trump's policies were to fail, well, higher levels of government debt have historically correlated to higher gold prices, especially as that requirement for quantitative easing may start to increase, which would further devalue the United States dollar in order to be able to help service some of that debt. Now, in this scenario, investors are obviously looking to preserve the value of their money, and unlike the US government, gold has no default risk, and therefore it is often used as a store of value for investors. But there are a couple of other macro risks that I want to briefly touch upon. The Russia-Ukraine conflict has continued, with Trump seemingly being unable to broker some kind of peace deal as things stand, along with the crisis going on over in the Middle East too. Now, I'm not sure how much I can say on these topics, but if you've been watching the news recently, then you'll understand exactly what I mean. And in times of unrest, gold has been historically a safe haven asset for investors. You've then got the US dollar devaluation, whereby the US dollar has actually declined by 11% since the start of the year. Now, there are lots of different reasons attributed to this, but we don't have time to discuss them all in today's video. But I guess financially prudent investors over in the US who can see the value of their domestic currency falling at a rapid rate of knots will potentially look to put that currency into some other form of asset in order to be able to offset the currency devaluation risk. And whilst that does seem to be a problem which is being experienced more over in the US right now, the UK certainly isn't immune from this problem, because the pound has also declined in value over many decades too. And that's all thanks to inflation, which of course is another risk factor to consider. Of course, the macro environment can also change though, and there have been periods of time, many periods of time in fact, where gold as an investment hasn't really stacked up all too well. To give a most recent example, between the market highs of 2020 to 2024, it just about broke even, which is obviously something to just bear in mind. So there's some of the macro themes that I've researched. Be sure to let me know what you're interested in down in the comments section below too. And if you're interested in learning why I stopped investing into individual stocks, then you might want to check out this video next. With that being said, I'll see you over in the next one.